We got to know some major news the other day. Bill Ackman bought a significant stake in Netflix that is worth a cool $1.1 billion. And this makes Ackman and his hedge fund one of the 20 largest shareholders of Netflix. Ackman acquired this stake after Netflix stock has basically been cut in half, which might have changed his mind because Ackman previously publicly stated that he thinks Netflix's business model is not particularly attractive and even unsustainable. So as you can see, there's a lot to unwrap here. Is Netflix really cheap, or did Ackman lose his mind? And so without further ado, let's get started. So what just happened? Well, Netflix stock has basically dropped by around 30% in just 1 week and 20% during just one trading day. So that's the largest one-day drop since 2012. And this happened after the streaming giant reported somewhat disappointing subscriber growth numbers and gave, in addition to that, weak subscriber growth guidance. So let's just take a brief look at the results they have reported in their most recent 10K. So Netflix reported 8.3 million new subscribers in its fourth quarter, which came in below management's own guidance of 8.5 million new subscribers, bringing the total paid membership count to 221 million. Now, to be fair, Reed Hastings, so the CEO of Netflix, he was not particularly impressed by this minor miss, as he has clearly shown during the investor conference call that followed the release of the Q4 earnings. What might have truly shocked the market though and led to the rapid sell-off is that management also guided for slower subscriber growth in Q1. Management announced that it expects to add 2.5 million new subscribers, which is basically half of what analysts were expecting. And to be fair, in the next couple of quarters, Netflix has to lap against incredibly tough comps, because Netflix has certainly been one of the biggest beneficiaries of lockdowns and widespread work from home policies. Of course, when you're stuck at home with not much else to do, Netflix is a terrific service. But it seems like we are getting closer to an end to the pandemic, thank God, and with more entertainment options becoming available, so theaters, concerts, eating out, and so on and so forth. Netflix may have a hard time convincing more and more new people to subscribe to its streaming service. And on top of that, investors might place even more emphasis on the question of competition right now, especially considering that Netflix just recently increased prices in the US and Canada, raising its standard plan, for example, from $13.99 to $15.49 per month. Now, just to wrap up the numbers part here, Netflix was able to increase its revenue by 16% year over year in Q4 and its operating income by 8.2%. Cash flow from operations, however, was a negative $400 million. Now, to get to Bill Ackman, here's what he wrote in his letter to shareholders in which he announced the Netflix transaction. The opportunity to acquire Netflix at an attractive valuation emerged when investors reacted negatively to the recent quarter's subscriber growth and management's short-term guidance. Netflix's substantial stock price decline was further exacerbated by recent market volatility. In total, Bill Ackman bought 3.1 million shares of Netflix, and he and his fund acquired this massive stake actually fairly quickly. According to Ackman and his letter, they started buying on Friday the 21st of January, and they announced their investment only 4 trading days later, on the 26th. Now, personally, I feel like the fact that Ackman initiated position in Netflix was rather surprising. And I think there are 2 reasons for this. Firstly, because Ackman has publicly stated that he doesn't like that Netflix business model requires constant and large reinvestments into new content, which he thinks doesn't have a very long shelf life. So he thinks the length of time newly produced content is attractive for streaming on demand customers is generally rather short. Let me just quickly show you a clip of Ackman appearing on CNBC in which he discussed this exact problem.
It's, 10 out of the top 10 artists, Drake, Taylor Swift, make your list, are universal artists. You have a company that has incredible historic content and a company that is where every great artist wants to, aspiring artist wants to, partner and have Universal, help them, break as a successful artist. And so I can't think of a business in a content space. I mean, Netflix is amazing, but they have to spend billions and billions of dollars to create content that is not so valuable, the day after you watch it, where music content is really forever. So
in that clip, Ackman basically contrasted the shelf life of music to the shelf life of video streaming content, which is mostly very short. Put differently, in music there are probably more evergreen titles than in video content streaming. You seriously just have to ask yourself how many songs there are that you are happy to listen to over and over again, and then ask yourself how many Netflix series you have actually watched more than once. Personally, I don't remember watching any Netflix series for a second time, quite frankly. Now, the second reason why I was surprised by this transaction is because one of Bill Ackman's core investing principles is to only invest in highly free cash flow generative businesses. This is also something that he has articulated publicly when he was interviewed by Rubenstein. So let me just show you a clip of that interview.
We went through a very difficult period, circa 2015, 2016. The two investments you mentioned were big drivers of that. It was, if you will, experiences making mistakes and learning from them. And it was a moment of reflection for the firm. And I went back to the core principles that have driven our success for the first 12 years. And I had a member of the investment team literally engrave them in a stone tablet, not dissimilar from Moses' 10 Commandments. And I had that stone tablet put in what you might call a deal toy. It sits on everyone's desk in the office. And we've adhered to those principles, ever since. And, we've been fortunate to return to the success we had for the first dozen years. So I think it's about keeping to, our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance. Sounds logical, but occasionally we've diverged, and there's those times, there's a certain discipline that comes with investments, and there always seems to be a countervailing quality that caused us to diverge. But in really each case where we've compromised on business quality or complexity, we've been harmed.
So one of Pershing Square's core investing principles is only to invest in free cash flow generative businesses. If we now take a look at Netflix's past financial results, we can see that Netflix hasn't really been a company that's gushing free cash flow. In fact, if we look at the financial results going back to 2014, then we can see that there have only been four quarters during which the streaming giant has been free cash flow positive. Although, to be fair, 4 of the last 8 quarters were actually free cash flow positive. But again, relative to Netflix valuation, the free cash flow produced by the company is really insignificant. So why did Ackman invest anyway? Did he abandon one of his core investing principles? Well, obviously we can only take guesses here. But what Ackman certainly understands very well is that the value of any asset usually or should reflect the value of all future cash flows discounted back to present value at some kind of appropriate discount rate. So the question is, how much of the money Netflix spends on the production of new content is actually maintenance spent, and how much is spent to grow the business and the subscriber base? In other words, how much content spent is necessary just to maintain the already existing subscriber base, and how much is spent to attract new subscribers? Netflix has certainly significantly increased content spent over the years. Just for comparison, in 2015, content spent was only around $3.4 billion. And this increased spending on content production is reflected in this chart by Twitter user Sleepwell Capital that shows produced content assets are now 55% compared to less than 10% in 2015. And this content spending seems to be paying off, at least when we look at Netflix churn rate. According to recent research from Antenna, Netflix churn rate is only around 2.4%, which is, again, incredibly low in comparison to competitors like Hulu with a churn rate of 4.1%. And this was nicely visualized by Medium in the chart that you can see on screen right now. And just in case you don't know, churn rate reflects the annual percentage rate at which customers stop subscribing to a service. So, depending on the answer to that question, so how much could Netflix cut its content spend without significantly increasing users' churn rate? Netflix may be significantly undervalued or massively overvalued. If we head over to Netflix's most recent cash flow statement, then we can see that in 2021, Netflix management spent $17.7 on new content. Let's just say Netflix could maintain a low churn rate and high customer retention rate if they drastically reduced content spend. Well, for example, just do $1 billion a year. Then Netflix's current valuation may be as low as 15 times 2021 free cash flow. Personally, I don't think this seems very likely, but it shows you that, this is the basically mother of all questions that Netflix investors need to ask themselves when they attempt to value Netflix. Let me just give a shout out to Hamish Hodder here, who did a fantastic video on this exact question and discussed it in depth in one of his videos. So if Netflix could theoretically reduce content spend and increase prices, this could significantly increase the free cash flow margins of Netflix and thus lead to more cash flows in the future, making the business more valuable today. And Bill Ackman certainly believes in the narrative that a large part of content spend does indeed reflect growth investments and that the business will be able to enjoy operating leverage. Operating leverage occurs when a company has a low amount of monthly fixed costs. Let's say Netflix only needs to spend $7 billion annually on new content. So there's a fixed cost to producing content. But if they now can continue hiking prices and grow the subscriber base, most of the added revenue will be pure profit. So over time, if Netflix can continue growing its user base, then the amount of cash they need to spend on content will take up a much lower percentage of revenue, and thus free cash flow should at some point constantly be positive. So as I said, Ackman seems to believe in exactly this narrative, and in his letter to shareholders that I have referenced earlier, he laid out his reasons for investing in Netflix. And let me just reference 3 of the reasons he laid out right here. So the first one was an improving free cash flow profile, which would allow for continued investment in growth as well as the return of cash to shareholders. Then substantial margin expansion with the opportunity for continued improvement due to economies of scale and the company's rapidly growing global subscriber base. And then lastly, and pricing power derived from the enormous value it delivers to consumers compared with other alternatives. And with that, I think I will wrap it up here. So as always, may your finances and investments prosper. Good luck.